meeting. Just want to welcome everybody and appreciate the support, the questions, the participation. We're going to cover a great topic today, investing in small apartments, which some of you may have done. Some of you may have done, a few of you have done large apartments. I've done both. Some of you, probably a lot of you, are looking at small apartments and are wondering, is this a good investment for me? How do I analyze it? Where do I find deals? What makes a good small apartment investment, and how do I minimize my risk? Is this the right time in the market? Am I doing it in the right market in my backyard, or should I go somewhere else? How do I do the math? Those are all the questions that I'm going to answer on this presentation today. If you have questions as you go, submit them through the chat, or easier through the Q&A portal there on your interface. So welcome. And by the way, this will be recorded. And so if you miss some of it or you want to watch a replay, you can always find it by going to legalwiz.com and then go to where it says free information, webinars, and I have a recording of just about every webinar I've done the last couple of years on Webinar Wednesday there for replay. Should be there in a couple of days. Okay. So investing. So my goal for you is to learn the concepts of profitable apartment investing and be able to take action on it ASAP from when you hear it. You know, a lot of people go to webinars, go to seminars, read books, buy courses, and they don't do anything. And that's a shame. It's kind of like a waste of money and time for you if you don't at least get one or two or three takeaways that you can implement right away. So if you hear something or see something on this webinar that piques your curiosity, that jives with your way of thinking, and you say, yeah, I could do that, then my recommendation is you take action on it as soon as possible before you forget or move on to something else, looking for, you know, the low-hanging fruit, because apartment investing is not necessarily low-hanging fruit in the scheme of things, but it is a very, very profitable way, if you do it right, to create income and retirement security. So what are your goals with doing this? Are you looking for quick cash? You could flip or wholesale a small apartment building. You can generate cash flow by buying and keeping it, or you can do what we call a turnaround, which is you buy it, turn it around, maybe increase the income, improve the buildings, reduce expenses and increase profitability, and then turn it around in 3 to 5 years, which is what a lot of people do with small apartments. It depends on what your goals are and what you're trying to do. If you need quick cash, find a good deal, bird dog it or wholesale it or flip it to another investor. If you need cash flow and you've got money to plunk down, you're looking for regular income, it's a great way to do it. If you're looking for a little of both, if you're looking for a deal where you can get in fairly light, meaning not too much cash out of pocket, not too much cash in fix up or renovation or turnaround, and then improve the value of the building by improving its cash flow and then turn it around in 3 to 5 years, that could also be a great way to play the game. And you could do this by yourself. You could do this with partners. You could put together a syndication if it's a big enough project and the numbers are big enough. There's so many ways to skin this proverbial cat. If you're looking for retirement income especially, you know, I can't think of going forward in an uncertain economy with the election looming and COVID and, you know, all the stock market and all the factors in the world. I can't think of a better investment right now than good multifamily properties that will continue to bring in income, continue to rise in value in most areas, you know, with exceptions, of course, but will continue to provide tax benefits as well as retirement security. So why apartments? Why should we be looking at small apartments? It's an economy of scale. If you are looking to generate, let's say, $10,000 a month in income for retirement or to get out of a job or a business and have passive income, you could buy a house or two at a time and generate $300 or $400 a month in cash flow, depending on how much you put down, how much cash you have, and how much you finance and how good of financing you get. But, it's going to take a long time and a lot of houses to get there, where if you're doing it in an economy of scale, doing many, many, many more units, rentable units in one purchase, as opposed to one per door per house with single family. It's cheaper cost per unit. If you look at what a 3-bedroom or a 2-bedroom apartment rents for against a 2-bedroom or 3-bedroom house, the house will rent for more, but the cost per unit to get in is a lot lighter than a single family house. Gives you a better return on capital for sure. It provides more income per capita than a single family. So also what I like about multifamily is it's less of a vacancy factor. When you've got one house and you get an email from your property manager saying the tenant has filled out an affidavit from the CDC and plans on not paying his rent, and he's stuck there till the end of the year and you can't evict him or do anything about it. Oh yeah, that really happened today. First one, it was bound to happen. So far, I've been pretty good. Most of my tenants have been paying, a little late, but mostly paying. But we just got one of those CDC affidavits, so we can't evict them. I'm basically stuck with them until either a court overturns it. There is a class action suit right now in Texas to overturn the CDC order banning non-payment evictions, but we'll see what happens. So if you've got one house and you've got one tenant and a tenant doesn't pay, you've got 100%, it's almost like a vacancy. You don't have any income. Or if there's an actual vacancy, there's two types of vacancies. There's physical vacancy and there's economic vacancy. If they're not paying, it's economic vacancy because you're not getting any income. Same thing, basically. So if you have 20 units, for example, and someone doesn't pay, you've got 19 other units to pay. Or if 5 don't pay, you still got 3/4 of them paying, and you can cover your overhead. And that's usually about a break-even point, for a multifamily, somewhere between 65 and 75% occupancy paying. Economic occupancy paying is your break-even point, and everything above that is gravy. And those don't quote me on that. That's going to depend on a lot of factors that we're going to go over in this webinar. It's easier to manage technically. It's all in one place. If you've got a 20-unit apartment building versus 20 houses scattered all over town, if you have a property manager, which you shouldn't be managing your own apartment buildings, it's easier for them to manage. You get bulk material discounts. It's the difference between 1 or 2 fridges in a house or two versus you're renovating an apartment building, you want to get 20 fridges, you can negotiate a discount. Bigger depreciation factor. If you're in a situation where you have a lot of income and you need a tax write-off, a nice apartment building can give you that depreciation, so it'll wash income that you have and save you in taxes. It's easier to finance in a lot of ways. The focus is more on the deal versus the borrower. Now, let me just make a distinction here. It's very important for you to understand. If it's 1, 2, 3, or 4 family, 4 units, then it falls in within Fannie Mae residential financing, which is kind of difficult to get. You got to put down more on a multi-unit than on a single family. So close to 30%, depending on the type of loan that you're getting, 20 to 30%. And they're very focused on the residential lending on the borrower, you. So your income, your credit, your reserves, and so forth. Whereas once you get a 5 units and above, now you're into commercial financing, no more Fannie Mae residential financing. And in that case, banks focus much more on the deal than the borrower, him or herself. So they're looking at, can the building support the loan that is being applied for? And of course, the borrower is important. It's got to have experience, got to have decent financials and credit and so forth. But when you get into the multi-million dollar large apartment buildings, you could borrow without recourse. I mean, no personal guarantee, no personal recourse. Basically, they just want to know that the person running the thing knows what they're doing, and that the building makes sense, or the buildings, if it's a multiple building development. But they focus much more on the deal than on the borrower. You can borrow $10 million without recourse, but you can't borrow $10,000 without recourse. Isn't that funny? You're more likely to get seller financing. And the reason is, in multi-units, you're more likely to get seller financing, is the fact that 5 family and up is not Fannie Mae residential financing. So there's sort of a no man's land between, depending on where you are and the values, of course. But if you're looking at an area, let's say that each unit is 100,000 per unit. So a 4-unit would be 400,000 and a 5-unit would be 500,000. So 500,000 up to $1 million, 5 units to 10 is a loan that doesn't fit into residential financing in that bucket, but isn't big enough for a lot of mortgage banks and commercial banks to want to deal with. So 5 to 10, 15, depending on the price per unit and where you are, is usually a sweet spot where you can get seller financing, because a lot of banks won't finance and there's not a lot of available financing out there except with some niche lenders here and there that deal in private money. It's not like when you get into Fannie Mae commercial financing, which is they do on big ones, multi-million-dollar projects, or FHA, or other banks like Wells Fargo and so forth. Private capital is easier to raise. Which would be easier? Think about it. If you go to some investors and say, listen, I want you to pony up in a blind pool 100 grand each, and I'm going to go out and buy a bunch of houses that we're going to rent out. Or if you said, look, here's a prospectus on this apartment building. It's 20 units. This is the income. These are the expenses. I want everyone to put up 100 grand for this project. It's a lot easier to convince people to put up money on something more concrete. You can, like I said, you can get non-recourse loans, and there's no number of loan limits. When you're doing a single family Fannie Mae residential financing, you can only have 4 loans of that type. Now, Fannie Mae will give another 6 for a total of 10, but that category of lending is very, very difficult to get. You have to have top credit scores, 6 months to a year's worth of reserves, put 30% down. Very difficult to qualify for. It's much easier, believe it or not, to get a commercial loan on a 10-unit apartment building and get those last 6 Fannie Mae residential loans. So there's no like limit on how many you can get. It's just a matter of deal by deal, project by project, whether they're going to give you a loan. Less cash invested. It's easier, believe it or not, to do no money down deals in multifamily than it is in single family, believe it or not. Now, let me qualify that statement I just made, that no money down. No money net down. You may have to put up money up front for due diligence, inspections, appraisal, and so forth. But if you're going to do a deal with partners putting up money and they'll reimburse you for that money, you could be net in a deal with no money out of pocket, if that makes sense. So it's easier to put together a deal with partners putting up the money, or seller financing where you're not having to put money down, but other people are putting money down, or a seller carrying back a second, where let's say the price is $1 million and you get a loan for $700,000, put $100,000 down, and then have the seller carry $200,000 as a second. There are lenders who will do that type of loan in today's market, where with a single family, it's just not available. It's also good to diversify your risk. If you've got nothing but single families and condos, it's good to diversify into some multifamily. Not all multifamily, but have, different ones. Tax write-off. Again, depreciation, huge write-off there for you. If you're in a high income tax bracket, could be a good investment. And of course, the most important thing is you can reach your goals faster. Again, the economy of scale. If we're going to get a goal of X amount of dollars per month in cash flow, when you buy 10 or 20 units at a time, it's a lot easier to get to your goals. So I want to start by dispelling the 5 biggest myths about small apartment investing. First big myth is that you need a lot of experience to do it. Now, if you're getting into large multifamily, yes, you do. Yes, you do need experience, because people are not going to lend to you, partner with you, put up money in those type of projects if you're a newbie. But if we're talking about a 5 or 6 or 8 unit building, you don't need a lot of experience to get into that type of investment. Now, I also must say that it's very important that you have property management that's qualified if you're a newbie. If you don't, and you're learning on a small apartment building about how to be a landlord, there's an old expression that goes like this: what you don't know about landlording, your tenants will teach you. Don't learn on an 8-unit apartment building. If you're going to manage yourself, start with single family or a duplex. Get your feet wet a little bit. If you're going to jump right in and buy a 10-unit apartment building, make sure you've got professional property management. Another myth is that you need a lot of money to do it too. Either you got to buy it all cash or you got to put 30% down. And as we've talked about already, that's not necessarily a thing that you need to worry about. If you find a good deal, the money will find you. You'll find partners or people who will lend you money if the deal makes sense. Another myth is that the risks are bigger because the numbers are bigger. Not necessarily so. As we talked about, in a single family house, if you lose a tenant for 3 months because of COVID, and you can't evict them, you've got no income coming in and you got a mortgage to pay. Whereas if you have 20 units and 5 aren't paying, you could still cover your overhead. So in some sense, the risks, can be bigger if you don't know what you're doing. If you know what you're doing and you educate yourself, you do the due diligence, small apartments can be no riskier than single families. The deals are more complicated. That kind of goes both ways. In a sense, people, I think, make them more complicated than they need to be. But if you learn the fundamentals that I'll talk about on this webinar and take the time to really become well-versed in what I'm talking about even more, you'll see that the deals are no more complicated. It takes longer usually because the due diligence period is obviously to inspect 10 units or get an appraisal on 10 units and get financing and get financials. It could be a 6-month close or a 4-month close versus a 2-month close or a month close on a single family house, but not necessarily more complicated. Or that you need to be a player. Those people who are a player will be able to raise money to get financing. And there's a hint of truth in that. Obviously, if you have a lot of experience, people are going to want to latch on to you and want to partner with you. But you don't necessarily need to be the player in the deal. So if you're putting together a 20-unit apartment building and then seeking partners in a syndication to give you money, they may be hesitant because of your lack of experience. How do you overcome that? Well, you can overcome that by bringing in a partner who does have experience. Me or whoever, in your market that's local, that has experience, that you could put on, as a managing member of your LLC, that you could point to and say, this person's on my team. They have a lot of experience. So you don't necessarily have to be the player yourself. You can bring players on board. People do it all the time. The formula for success in small apartment investing is as follows. It's very simple. Buy at the right time, buy the right properties, buy in the right market, and buy with the right fundamentals. So there's 4 things you want to know, and you want to write those down. Buy at the right time in the market, buy the right type of properties, buy in the right markets, buy with the right fundamentals. And as we'll see, number 4 is going to be probably the most important of all 4, because right market, do I invest in Colorado Springs? Do I invest in Duluth? Do I invest in Miami? Do I invest in New York? I'll tell you right now, that's a bad idea. Everybody knows that already. But, and that was even before COVID, rent control, high taxes, bad place to invest. But I digress. The right fundamentals, you can find something in your backyard. The right properties are very important. The right timing, that matters to a point, but there are deals in every part of the market, and there are strategies for working this in every part of the market, whether it's up, down, sideways, or anything in between. Okay, so let's get into it. First, an example of timing. This is timing can be almost everything in a good deal. This is a 4-plex I bought in Grand Junction, Colorado, a place where, frankly, I've never been. One of my students came to me and said, hey, I have this 4-plex under contract and I can wholesale it to you for $5,000 fee. And I took it. I paid $127 for this brick 4-plex, 4 2-bedroom units, and then sold it a few years later for $185,000 just in timing. That's all it was. It was a good cash flow property, no doubt. I mean, at that cheap of a price. But timing-wise, it was when the oil and gas boom was hitting the west side of Colorado and prices spiked up, and so did rents, which when rents go up, your multifamily value goes up, as we'll see from the math we go over in a little bit. So I did a nice deal on that one. Like I said, never saw it, never been to Grand Junction. I didn't manage it personally. I had someone else do it, and still made a nice chunk and didn't pay taxes on it either, by the way. I did what's called a 1031 tax-deferred exchange and rolled it into something else. So a nice little deal, $58,000 profit. Here's another one I bought in South Florida in 2001. I paid, get this, $125,000 for 8 units. Now, this was a pretty rough neighborhood. I wouldn't recommend this to everybody. In fact, I bought it also sight unseen, based on an appraisal, based on financials, and $125,000. Man, how bad can you do it, right? It's cheap. But what I liked about it was an up and coming area. It was a D-class neighborhood, as we'll talk about what that means in a little bit. But downtown Palm Beach, South Florida, they were renovating and putting a new theater in and shops and restaurants, and it wasn't far from there. So I saw the potential there. And in 4 years, the property went from 125, and I sold it in 2005, right before, I'm trying to remember what hurricane that was. I think it was Andrew, if I'm not mistaken. $280,000 and made $155,000 profit. Also did a tax deferred exchange on that one into some other properties and didn't pay any tax. But again, just, you know, in a short period of time, 4 years, had a lot of cash flow in the meantime too. But my realtor came to me in 2005 and said, this is the top of the market, sell it now, which was, he was 2 years too early, but thankfully he didn't come to me in 2009. Would have been a lot of trouble. So let's look at market timing and the way it works. So this little diagram here shows time left to right, and then you get prices on the vertical axis. Actually, it doesn't really look like this. You know, I just didn't know how to do it graphically. I'm not that computer savvy, but this should be slightly tilted on a left to coming up right angle. So the peak of the next one is higher than the peak of the former one. So it goes up and down, but it goes up and down generally and peaks a little differently. Stephen asks, what do selling fees look like on the deals you showed only gross profits? Those were actually net profits, Steve. I simplified the example. That was net to me, not gross. But the fees on that are just like any other real estate transaction. You're looking at realtor fees. You're looking at, you know, typical closing costs on a multifamily are not that much higher than residential with a title company or attorney. And the realtor fees are typically in the same range of 4 to 6%. So time is left to right, and then prices are up and down. Okay, so basically there's 4 market cycles here. There's buyer's market 1, buyer's market 2, seller's market 1, seller's market 2, and then it cycles around again. Okay, again, the peak should be on this one on the right, should be higher than the one on the left. It shouldn't look like a camel's hump. It should look like, you know, on an angle a little bit, okay? Now let's go into what each of those mean. First, we want to buy at the bottom, buyer's market 2, and we want to sell at the top. Duh, but there's only one problem. They don't ring a bell at the top of the market or the bottom of the market. So we have to look at what the signs are showing in the market. So we'll come back to that in a few minutes, but basically you need to look at what inventory looks like. You know, is inventory increasing or decreasing, the number of properties for sale? If they are increasing, it usually means an indication that you're headed to the end of a cycle or starting to get into a seller's market versus a buyer's market. When inventory, it's a low, you know you're pretty near or close to the bottom, okay? So prices is a factor of supply and demand, okay? So if demand outstrips supply, prices are going to go up, and the opposite is also true. So again, they don't ring a bell, but you could kind of see what's going on. I mean, a lot of people knew that the market was going to bust at the end of the 2007, 8, or 9. It was just a matter of when. Most people could see that prices were getting too high. People were getting unreasonable demands as sellers, and then inventory started to increase and prices started to flatten. That's an indication that you've hit the peak and you're starting to get the trend downward, but there's a lag. It's not like the stock market where you wake up one morning, you know, and Iran has the bomb and, you know, the stock market goes down 800 points. It's a slow moving, like a big ship. And while it's not clear sometimes when you're on a ship which direction you're going, you could see after the wake of the ship which direction it was just coming from and get an idea what the trend is. You got to know the trend. A good friend of mine, a very smart individual, once told me, the trend is your friend. Got to know the trend. So right timing is important. We want to buy, as best we can in a buyer's market and sell in a top of the seller's market. It's not always possible though, because where the heck are we now? Well, it depends on a lot of times what neighborhood or city you're investing in, but generally speaking, it's a seller's market right now. Prices are very high, which means the deals you're going to get are generally pretty low unless you find something that falls between the cracks, a motivated seller who ran out of money, ran out of patience, doesn't know what to do, got drinking problems, marital problems, whatever. Just find a deal. And we'll talk about what that is in a little bit. But the right properties is what I want to talk about next. There are 4 classes in apartments. There's A, B, C, and D. And Class A is the new stuff. It's less than 10 years old. It's in excellent condition, has lots of amenities. It's the stuff you and I would want to live in. Class B is a step below that. It was a Class A at one time, but it's getting a little dated, a little old. Still in pretty good shape, though. That's probably where your kids are going to live. Class C apartments are much older, 30 to 40, sometimes 50 years old or more. As early as the 50s and 60s could be still be Class C apartments. They're fairly stable, but they generally need some work, and they offer a good value play. Now, they tend to also have crime to some extent. You're going to have a little bit of drug dealing and minor, stuff like that. And as long as it's not overwhelming, your apartment building, that's sort of par for the course in a Class C apartment. Class D is like the shotgun neighborhoods. This is the inner city ghetto. Half the buildings are boarded up. There's gangs everywhere. There's people getting shot. And, some people still make money in those markets. They want to be landlords because they can get it really, 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 really cheap and get good cash flow. But I would highly recommend you stay away from that type of stuff, especially if you're a newbie. Stay away from Class D and stay away from Class A, because Class A is volatile. When the market turns and it becomes a buyer's market, Class A is going to depreciate very quickly. Class B, not so much. Class C tends to be more stable because that's where the most amount of renters you're going to find are. Your lower income, not dirt poor, but lower income, maybe 20 or 30% might be Section 8 housing tenants. The rest are just kind of blue collar working class, depending on the neighborhood. But that is, C, what I call C plus, B minus. That's sort of the sweet spot that you want to be in, of cost per unit versus cash flow versus headache versus risk. That tends to be the best type of properties. Now, if you get into BB plus properties, they're much less headache. They're much more stable, but they usually don't produce the returns that Class C does. So there's A, B, C, and D, but you could sort of rate something as C plus, like the high end of C or the low end of B. That's going to be your sweet spot. The right market is all about location, location, location. Buy in the right markets. Now, let's look at macro versus micro when we talk about buying in the right markets. Macro view is, where are the jobs? Because you want paying tenants. You want demand, okay? Demand. You don't want to buy in a market where people are running out of the city. Like San Francisco, rents are down 25% year over year. 25%, that's a record. That is a record drop. Why? Because people are running from San Francisco because of COVID, because of unaffordability, because of crime, because of mismanagement of the city. People are just kind of running from the cities right now for a number of reasons, one of which is COVID, one of which is crime, one of which is taxes, and the last of which is sort of a long-term trend of people realizing with COVID that, hey, I could live 30, 40, 50 miles from my job. I only have to come in maybe a couple days a week, and then I could remotely work. Or I can remotely work permanently. That might be just a complete change fundamentally of the job market. And if that's the case, then why do you need to live in an expensive crime-ridden city with high taxes and poor management? So you go where the jobs are. Jobs are what drives the economy. Go where there's a low supply of housing too. So supply and demand. So if supply is low of this particular type, and let's say we're looking at C plus B minus, that's a good sweet spot because supply of that is really low all over the country right now. They haven't built, people don't generally build from the ground up C-class housing unless it's subsidized by a local government. They build A-class housing or B-class housing. And usually mostly A, and A becomes B. And then C is what was once B 30 or 40 or 50 years ago, before the neighborhood turned, before the building got old. So there's buy where there's a low supply of housing, and that's that sweet spot. But in the areas where there's no major influx of builders building new buildings or things that happen that will open up supply of housing that'll affect your overall picture. Go where the jobs are, that's the demand. Go where there's limited building. So college towns tend to be good, and sellers know that, so it's hard to get a super deal in a market like that. But if you go in a college town or a city that is the capital, if you go to like Austin, Texas, that has both. It's both a capital city, it's a college town, and it also has limited building because of moratoriums the city puts on how fast they want the city to grow. So that's always a good thing if you're a landlord. Go where the economy has been improving, the up and coming markets. And you can get, by the way, you can buy reports of this stuff online. If you Google, housing market reports or multifamily housing market reports, there's a dozen different providers of that. You can buy a report on a city for maybe $100 to $150, and it'll tell you within zip codes what's going on in not only in the market in general, but the submarkets, the suburbs or the northeast, southwest, side of that particular market. They can give you very specific numbers of how many units are for rent, how many units are for sale, what the average rents are. This is really good information that you need to know. And where's the long-term growth? I like to look at what Walmart does. Walmart could build a brand new store and lose money for 3 years because they know in 5 or 10 years they'll make it back because of long-term growth. So when you see a Walmart going up and you're going, why would Walmart put up something over here? There's nobody lives here. They know something you don't and I don't. They are looking at the long-term trends, and they're smarter than we are, so follow it. Starbucks. When Starbucks comes into town, all of a sudden into an area where they had no Starbucks, they think it's up and coming. They do their research. So follow that advice. The micro view. Let's looking at the particular building or the particular area. What nearby amenities are there? What are the property taxes like? What are the schools like? What is the crime situation? And these are all reports, by the way, you can get online for any zip code that you need to do. What does future growth look like for this particular neighborhood? So we're looking at the macro view, the city or the submarket, and then into the neighborhood view, the micro view. And what are rents versus values? And that's an important distinction that you need to make is, cost per unit versus average amount of income per unit for that particular neighborhood. And there are sweet spots in every city. The right fundamentals. So we talked about timing. We talked about type of property. We talked about markets. Now we're going to talk about fundamentals. And this is going to spend the bulk of our time on this webinar today. So we're going to look at things like capitalization rate, expense ratio, debt coverage ratio, and rates of return. Now there's actually about 9 more formulas in multifamily, which I'm not going to have time to cover in this short webinar presentation, but these are the basics that everybody has to know to invest in multifamily. So we start with what's called gross scheduled income. You always look at an apartment building not necessarily from what it is, what it was, but rather what it should be. And this is what's called a pro forma analysis. Pro forma, what if, okay? So for example, if you looked at a building that had 10 units and market rent was 1,000, would you put in 800 if they were currently getting 800? No, you would put in 1,000 as your gross scheduled income. So if there's 10 units and the market rent is 1,000, and you can go on the reports I talked about and find what market rent is in particular submarkets or areas for a class of property, B, C, A, etc. You go by what's typical for the area, because rents could be low because the landlord is a self-manager, has tenants who've been there forever and don't complain. And that's not always a good thing, by the way. Sometimes when tenants don't complain, things are just wearing out and breaking and they're not saying anything about it, and your building is getting dilapidated. So don't think because tenants aren't complaining that you're in a good situation or you have good tenants. But if, let's say he's only getting $800 a month for 10 units, $8,000 a month versus $10,000 a month. We use the $10,000 a month number because we want to figure what it could be or should be if you were getting market rent. Now, you have to know why they're not getting market rent, and can you overcome that? Is it just a matter of poor management or poor decisions, or is it a matter of the building just is never going to command $1,000 like the competition because it doesn't have particular types of finishes or parking or whatever it is that the competitors do, and what's it going to cost to bring it up to market? Okay, so we start with gross scheduled income. What if everything was rented at market? Then we subtract vacancy factor. Is that actual vacancy now? Is it historical for the last year or two? No, it's market vacancy. So if the seller says, well, I'm 100% occupied, that doesn't mean anything, because if the market area has an average vacancy rate of 5%, then we go with 5%. Okay, and the fewer the number of units, the bigger cushion you're going to have to use there, because if you have, any of you know who've had single family houses know that even if market vacancy is 3%, if you lose a tenant 1 month, that's 8% per year. Okay, so if you have 1,000 units, you'll average out to 3%, but if you only have 10 units, it may be a higher number. So just fudge that number a little bit higher. And that will give you gross effective income, And it's important you understand these terms, because a lot of realtors will, throw pro formas at you and say, this is, what it is. This is the vacancy, what it is. This is the rents they're collecting. These are the expenses that are or historically been. And, either A, they don't know any better, which is about 80% of the time, or 20% of the time, they're just trying to fool you. And then because they don't think you know what you're doing. So you got to know this is the way it's done. This is according to the Commercial Institute, CCIM Institute. This is the way it's always done. Pro forma analysis, gross scheduled income minus average vacancy gives you a gross effective income. And then you're going to subtract operating expenses of the building. And then that's going to give you what's called NOI, or net operating income. So we go pro forma, what if it was all rented at market, subtract market vacancy, subtract operating expenses, and that will give you net operating income. By the way, operating expenses, which I'll show you in a minute, are we going to look at historical, or are we going to look at current? No, we're going to look at averages for the market, okay? Because it's possible they just renovated the building a year ago up and down, and their expenses are really low for the last year or two. Okay, so you're going to be fooled into thinking that expenses are very low, and eventually those expenses will start creeping up because as those improvements get older, as the building needs more work. So we go by what's typical for the neighborhood. All right, now, operating expenses, what do those include? This is where people really mess up, especially on a small building, like 8 or 10 units. They'll get a prospectus from a realtor or a seller that says, well, rent is X, and my expenses are utilities, taxes, and property repairs as follows, whatever I laid out last year. It's not accurate. It's not accurate. You have to include repairs and maintenance. Now, repairs and maintenance are two different things. Repairs are things that break. A tenant breaks a door, you replace the door. Okay, a tenant breaks an appliance, or appliance goes, you replace the appliance. Maintenance is just a percentage of the value of the building that's just going to wear out over time. So for example, if it costs, let's say you have a building with a flat roof that costs 60 grand to replace. And let's say that roof is good for 20 years, just throwing a number out there, okay? That means you have to set aside $3,000 a year into a maintenance fund to eventually fund that roof. You don't just say, well, the roof went this year, so that's going to cost me 60 and my numbers are off this year. No, you put aside a percentage for maintenance each year in your numbers. Management. I self-manage. That's goody for you. I, as a sophisticated investor buyer, are not going to self-manage. I'm going to pay a management company because my time is worth something and I could do it better by hiring a management company and finding better deals. That's what you should be doing. Okay? So management, and that could be 8 to 10% of gross rents. Legal and accounting. It's amazing. People, I say, what's your legal and accounting expenses? They go, well, I don't have any. You don't have a bookkeeper? You don't have a CPA who prepares your LLC return every year? You don't have to do evictions? You don't talk to an attorney about lease clauses or problems you have? You don't talk to your CPA about how to avoid taxes? Of course there's legal and accounting expenses. Utilities, services, property taxes, insurance, that's just the beginning. That's just the beginning. It does not include, however, principal and interest, which I misspelled. It's principal, PAL, capital expenditures, depreciation, income taxes, amortization, and loan points. So sifting through that, the basic thing it's not included as an operating expense, the mortgage payment. It's not an operating expense. I can't tell you how many people don't understand this. When you're calculating operating expenses, you do not include the mortgage payment. So what about the mortgage payment? Isn't that irrelevant? Yes, in another equation it is. But in the beginning, if we want to compare the performance of building A to building B, we have to look at it vis-a-vis the mortgage. Because if you put 20% down or 40% down or nothing down, if you get a 30-year note versus a 20-year note, if you get 6% interest versus 3% interest, that's going to change all the math. And yes, in cash flow, that matters. But for this calculation, calculating net operating income, we ignore the mortgage. And we compare the performance of building A to building B based upon what's called its capitalization rate. So the first one we want to know is the expense ratio. And that's the ratio of operating expenses to gross effective income. Not gross schedule, gross effective. I should have put effective in there. So what is the ratio of operating expenses to gross effective income? Typical expense ratios for a single family is about 25%. So for every dollar you get, and this is vis-a-vis the mortgage again, if you collect $1 in rent on a single family, you're going to pay 25 cents in insurance, management, maintenance, utilities, repairs, etc. And you know, that's exactly the number that banks use. When you go to apply for a loan and you have an existing mortgage on a rental property and you're collecting $1,200 a month, they're going to discount that $1,200 by 25% right off the bat. That's the standard formula. For 2 to 4 family, figure 30 to 35%, and this is in C class. 5 to 50 is going to be 40 to 50%. 50%, yeah, half. But then as you get over 50, it can decrease because of the economies of scale and because of efficiencies in operation if you have hundreds of units. So a sort of shorthand formula that I was taught by my mom, who was a savvy commercial real estate investor, and if you look this up on the CCIM website, it's pretty darn close. I've looked it up before. It was within 1%. But the rule of thumb is in C-class apartments, half of your income will go to expenses other than mortgage. So if you're collecting $10,000 a month, you got to figure you're going to net $5,000 a month. I know that's going to change slightly depending on the age of the building, how recently renovations have been done, what services or utilities you're providing. Yes, that's going to fluctuate. But a good back of the napkin formula is if a seller says, well, I got 10 units, he says, well, what are you collecting? $1,000. Just assume that's market for now. Okay, so he's got 10,000 a month times 12. We do this annually. That's 120 grand a year. You got to figure 60 of that's going to go to everything but mortgage. And you can do that on the back of a napkin. Now, of course, you're going to do actual numbers. That's just a rule of thumb, just like fix and flippers do 70% of ARV minus repairs. You got to actually put it through a spreadsheet. But these are just rough numbers that you can rely on. 2 formulas you're going to have to learn. Yes, we're doing algebra today. Oh my God, hard math. Bill, what are you doing to me? No, it's actually pretty simple math. Some of you, I'm going to harken back to your misspent youth in middle school or they called it junior high where I was. Two algebraic formulas. Remember A equals B over C? Okay, so cap rate or capitalization rate is the net operating income of the project divided by the purchase price that you're going to pay. Or if you want to look at it as what is the seller asking, we could figure out what the cap rate at that asking price would be, okay? Now, doing a little algebra here, you remember if A equals B over C, then C equals A over B. So we're moving purchase price to one side and putting cap rate underneath. Why can I do that? Trust me, if you don't know basic algebra, take my word for it. You can do that. If A equals B over C, then C equals A over B. It's the same formula, okay, in algebra. So the value of the property to you is the net operating income divided by the cap rate that you're looking for. What's a good cap rate? You know, I'll give you the lawyer answer. It depends. You know, it might, for you, might be 10%. It might be 6%. In some markets, average cap rate is 3.5%. Like in my market, a lot of stuff is the typical cap rate is 3.5% on a selling property. To me, that sucks. That is beyond sucks. Because if you have to borrow at 4%, well, how could you survive on a 3.5% cap rate? You can't do that. It doesn't work. But if you know what cap rate you're looking for, you can take the NOI of the building by simply saying, what's he collecting, divide by 2, and then divide that by your cap rate that you're looking for, and that'll tell you what to pay for the building. It's as simple as that. Let's look at an example so you can plug this all in. And by the way, one more formula, and then we'll go into an example. Another one we want to look at besides cap rate, which is more important, I believe, than cap rate, is what's called cash on cash return. Cash on cash return. What does that mean? Cash on cash return is your net cash flow divided by your all-in cash. And you'll see a little description on the bottom. What is net cash flow? Net cash flow is net operating income minus your mortgage payment. So now the mortgage payment becomes relevant. The denominator, your all-in, is your down payment plus your closing costs and any immediate renovations that are necessary to bring the income to the point where you're using in the numerator, okay? So basically, if you wanted to simplify it, just say my NOI minus my mortgage payment is numerator, and the denominator is my down payment. Okay, that'll give you your annual cash on cash return. All right, I see a question here. Yeah, Ed asks, isn't a roof a capital expenditure or an expense? Please explain the difference between both. Thank you, Ed. That's a good, excellent question. Expenses that you write off in the year they are incurred are ordinary expenses. Capital expenditures are amortized over the useful life of what you're replacing. That's an IRS designation, but it's also the same thing when we do the fund. Remember, I talk about putting together a capital improvement fund of 1x% of the useful life of what is wearing out. So if you have a parking lot, the big ones, parking lot, roof, HVAC, windows, those have useful lives, okay? So you should be setting aside X amount in your cash flow analysis. All right, let's put it all together into a formula. You'll also notice, looking at algebra here, I'm going to go back for a second. If cash on cash equals net cash flow divided by your down payment, therefore, the more cash down payment you put up, the lower your cash on cash return. Why? Look at the algebraic formula. Numerator is net cash flow. The denominator is down payment. The bigger the denominator, the smaller the cash on cash number percentage, okay? And the lower the cash on cash return. So the idea is the less we put down, the more return we get on our money, okay? Here's an example of 10 units. So let's say we have 10 units at $1,000 a unit. Market rent is $10,000 a month or $120,000 a year. And we're going to do this on an annual pro forma basis, remember. Okay, so I don't care if actual rents are $800. I want to go by market, what I can get it up to in a reasonable period of time. Also, sometimes realtors will show you an analysis that says, well, market rent is 1,000. So next year's analysis is, here's the same units, 10 units at 1,000 a month versus its current 800. That presumes you're going to raise rent from $800 to $1,000 on 10 tenants, and none of them are going to leave. That's unrealistic. It may take you 3 years to get there, okay, to turn over the tenants. So just keep that one in mind. $120,000 a year in income. Vacancy, $10,000 a year. Operating expenses are $40,000 a year, okay? Now, how did I calculate these? This is what the seller provided, or the seller's realtor provided, okay? We're just going to go right off of assuming what they're saying is true, which is if their lips are moving, they're lying. Well, let's just take it at face value. They got 10 units, $10,000 a month, $120 a year. They got a $10,000 a year vacancy right now. We're going to assume that's market. They got operating expenses of $40,000 a year in the last year average or two average. We'll take that at face value. So the net operating income is thus $70,000 a year. So 120 minus 10 minus 40 is $70,000 a year NOI. The asking price is $1 million. So let's do the math. The cap rate would equal the NOI of 70 divided by the asking price of 1 million, which gives you 0.07 or a 7 cap. Now, earlier I said 3.5 is the going rate in my market. Is 7 good? I used to think 7 was fair. Now, 7's a steal. So that would be an acceptable cap rate in today's market. Let's look further. The asking price is $1 million. You negotiate, the NOI is 70 a year, and you negotiate a seller carry with $200,000 down and the rest at 5% interest only. Why interest only? Because I could do the math on that. And you could do the math on that. So interest payments on $800,000 a year at 5% is $40,000 a year, right? You can do that on the back of a napkin. And the reason I did that was to make the math easy for you. So I know that's not always realistic. You're going to get a seller to carry $200,000 down and 5% interest only, or you'd want interest only as opposed to amortized, but it makes the math neat for the example. So the net cash flow per year is the 70,000 NOI minus the 40,000 in interest payments, which equals net cash flow of $30,000 per year. The cash on cash is thus 30 divided by the 200 down payment, which is 15%. Now that happens to be a very good cash on cash return. Cash on cash return is what you're earning annually on your money. Forget about the tax benefit, forget about appreciation, forget about everything else. Just what are you earning per year on the money you invested? Now, if you never plan to sell it, then this is all that matters. Cap rate is not that important. Cash on cash is what's important. If you plan on selling within 3 to 5 years, there's other formulas you need to look at, which extrapolate your profit, not just of your cash flow, but your back-end equity, which, beyond the discussion we're having today. But that's how you calculate cash on cash. And 15, by the way, is very good. Try earning that consistently in the market, which is going like this these days, or in a savings account or a bond. Okay, let's take a few questions. Then I'm going to wrap it up with a few thoughts. And if you have any questions, please post them on the Q&A or in the chat. In order to be involved in this stuff, you got to think a little bigger. A lot of people are intimidated by apartments. They're intrigued by it. They want to invest in small apartments. They dream of investing in small apartments, but they're not thinking big enough. You got to be able to think bigger. And that's the idea of getting involved. Jim Rohn, who was Tony Robbins' mentor, said, you could become the average sum of the 5 people with whom you associate with. So if you want to think big, hang around with big thinkers. Hang around with people who are thinking big already, and they will rub off on you. If you hang around with small thinkers, your net worth is going to be much less than if you hang around with big thinkers. In the book, Think and Grow Rich, which was one of my favorite books, by the way. And if you don't have a copy or you never read this, email me, bill@bronchick.com, and I'll email you a free copy of this book, bill@bronchick.com. Being decisive makes you rich as a real estate investor. Napoleon Hill wrote in chapter 6, analysis of several hundred people who had accumulated fortunes well beyond the $1 million mark, today billion, disclosed the fact that every one of them had the habit of reaching decisions promptly. People who fail to accumulate money without exception have the habit of reaching decisions, if at all, very slowly. being a decision maker, being able to know enough to make a decent analysis, what I've covered so far and more, backwards and forwards, you're not going to know 100%, but if you can take a calculated risk, you got to be able to be a decision maker. Otherwise, someone else is going to be a decision maker and get the deal from you. Play big, live big. We'll always have problems. If you don't want to get into multifamily because you think there's too many problems, let me tell you something. If you think that because you have single family rentals and they're problematic that you're afraid that multifamily will be bigger problems, the answer is you're right. But bigger problems dwarf little problems. If you want to get rid of your problems, just get bigger ones. The little problems seem to go away. If you think people who are successful on a bigger level or richer have less problems, you're deluding yourself. Everybody has problems. So if you want to get rid of your problems, get bigger ones. And accept that. Once you accept that bigger problems are part of playing big, you'll be able to play on a big scale. If you're afraid of playing big because you're afraid of bigger problems, you'll never get anywhere in life. Just accept the fact that with playing big in real estate, you get bigger problems, and that's okay. They are challenges that you can overcome and deal with, okay? Let's deal with a couple of questions, and then we're going to do a Q&A and wrap it up. Alan asked, can you show the cap rate math example slide again? Alan, I cannot. I cannot go back all the way on this presentation, but I can give you the formula. Capitalization rate equals NOI, net operating income, divided by the price either that you're going to pay, going to offer, or what the seller's asking if you want to determine what cap rate it translates to at that asking price. Stephen says, I struggle with this because I cannot find people who think as big as me. Well, first of all, Stephen, congrats to you for thinking big. But what you need is what Napoleon Hill talks about in his book called the mastermind principle. You need to get into a mastermind of people who are big thinkers. Read that in the book. And remember that one good deal in multifamily can set you up for life. So it may take longer. It may be more, to you at least, more complicated, even though it doesn't have to be. But one good deal can set you up for life if you do it by the book the way I'm teaching you. So I encourage you to learn more, read more, and you can pick up my course on investing in small apartments at legalwiz.com/store. I believe it is alphabetically I, not A. So I have 19 courses there. This course comes with a PDF course manual, streaming videos, audio downloads, checklists, forms and contracts, and 90 days email support. It's only $497, which is, talk about being decisive and taking a calculated risk. Be decisive and take a calculated risk. If you're going to take calculated risks, learn first. Learn first. So it's $497 is not an expense. It is an investment because you can make a much bigger mistake. I, not that long ago, had a client who paid me literally to fly me to another city to look at an apartment building. And I said, well, show me what you have so far. And everything looked really great, by the way. The numbers looked great. The neighborhood was great. It was a C-class building in a B-plus neighborhood. It was just, there's so many things that made this a great deal. But the building had a few structural problems, and we hired a structural engineer, and that cost him $7,000. And the structural engineer came back and said, this is the second worst foundation I've seen in my life. And he bailed on the deal. Now, I consider that a savings, because if he had done the deal and not paid the $7,000 for the inspector, he could have made a much bigger mistake. But here's what I'm telling you. $497 compared to $7,000. Don't be penny wise and pound foolish. Like the Midas muffler man used to say, or maybe it was the Meineke guy. Yeah, it was the Meineke guy used to say, you can pay me now or you can pay me later. Pay me now. So use the code webinar, by the way, and get a 30% discount on that course. So it makes it even better. That's good through the weekend. So make sure that you go to legalwiz.com/store, or just click on store at legalwiz.com and find the Investing in Small Apartments course. and put in the code webinar and give you a 30% discount on the way out. Great course, and it goes over everything I've talked about and then some. Okay. Let's see if we have any questions. Alan says it was the Fram oil filter guy who said, "Pay me now or pay me later." Interesting. I thought it was George who said it on the Meineke commercial. You can pay me now, you can pay me later. Wasn't it George Foreman? I guess I'm wrong. It was the Fram oil filter guy. Very interesting. Thank you for that little tidbit. Okay. All right. So we have a few more questions, and kudos. Thank you. Thank you. Thank you. Thank you. Thank you for putting this on. Yes, it's my pleasure. Ed asked me, what markets are you looking in now? Well, I'm not looking in San Francisco and New York. That's for darn sure. I'm looking mostly in the West and the South, and possibly some Midwest. But the Northeast and the Pacific West are dying. Big problems with all the cities. Mohammed, thank you for the compliment. I appreciate that. Thank you, everyone, for joining. I enjoy putting these on, and I enjoy the fact that I get good questions from everybody who participates. So go on over to legalwiz.com if you want to learn more about this. And my course is very comprehensive. It's only $497 minus 30%, so you can't go wrong. All right. Have a great day. Stay safe, everybody, and get out and vote next Tuesday. Goodbye.